What I want to focus on today is what is that impact, though, to the United States economy? And there's two major things that Russia or Ukraine export. And the first is oil. They're the world's third largest oil producer. And when you look at the pie on the left, you can see how much Asia and Europe is impacted by Russia's exporting oil to them, making it very difficult to bring in sanctions or respond to the situation over in Russia and Ukraine. However, when you look at the U.S., in here, it's a very, very small percentage of our oil consumption. Most of our oil comes from Canada and Mexico and ourselves. So we have not been energy dependent on Russia. When you look at the right side of this chart, the Russia-Ukraine produced 25% of the global grain exports. Again, Europe, a big consumer, Egypt, Turkey, a little bit China too. But the U.S. is not a major consumer of Russia and Ukraine grain. So what does that tell us? That really from an economic standpoint, we would be impacted minimally, Dan, compared to the rest of the world. So what that brings us back to is really inflation is what's going on in the U.S. that's causing most of our problems right here today. So
yeah, it is interesting because I think Ben Carson said this, that we really do want to get some kind of alternative energy other than just the fossil fuels. I think that long term that's important. We've got to come up with another energy source. But one of the things he said was that you don't stop what's allowing you to grow to then focus on the new energy sources before you get the new energy sources in play. Yeah. So it might be wise if the current White House would kind of let us do the thing with oil and at the same time, work on that alternative energy, because yep. I think it's a good thing to do.
You can do both.
Absolutely.
We're not restricted.
Absolutely.
So now that we know what's going on, the geopolitical conflict, the inflation situation, what does history tell us? So when you're looking at the inflation and the markets, monetary tightening plus growth still can mean there could be good equity returns. This chart shows us that through all cycles, the left two bars, in the first year of the Fed tightening, increasing interest rates, the stock market historically has averaged 7.8% return, the S&P 500. In the second year, 5%. The middle bars show that if the economy is actually expanding and we're in a good economic situation and the Fed starts raising interest rates, we could see double-digit returns in the first and second year. The third set of bars, though, reflect what happens if the country is actually, the economy is in a recession, we're not growing the economy, what's the return of the S&P? And you can see it's significantly lower, 5.8% in the first year and 3.4% in the second year. So what this is telling us is, and why the stock market is so volatile and why we've seen a drop in the stock market, a correction starting to take place, is because people are not sure right where we're at right now. We've been expanding. We are still expanding, which puts us in the middle chart. But there's concerns that we could be heading to a recession, and that means that there could be lower returns in the future, thus the market volatility as we're trying to weather through this current inflation cycle that we're in and the Fed raising interest rates. When you look at conflicts, we've had them. This chart takes you back to 1975, and you can see a whole list of different geopolitical events that had taken place over the past 30, 40 years that we somehow have been able to power through those different events, and the stock market can still move forward even though there's conflict going around the world. So